Thanks for watching. I'm trying to see if the internet's good enough for a stream tonight. It wasn't working last night, so we'll see tonight, but it seems to be working better today. Um, so I've been working on, actually, let me show where I'm at really quick. Um, I've got a really good model. Actually, let me go up and show here. So these are my goals. So the first goal is to beat the S&P 500 by a significant margin. It goes up on average 6% per year. I want to 3 or 4 times the performance of the S&P and go up on average 18 to 24% per year. And my second goal is stay market neutral. So this should be reliable regardless of what the market's doing. If the market's going up, going down, this should reliably return 18 to 24%. My second goal I have is to, so I'm writing all of this in Python. I'm generalizing it so you can kind of do it for anything. And so I want to use this generalized version to create a usable Python tool so anyone can implement these strategies for themselves. So if you're interested in that, check out the GitHub. The link's in the description. You can find it here on my GitHub, stock market tool. And if it helps me, I think it helps me if you try it out, download it, fork it, test it out for yourself, see how it works. I have the model I'm about to show is all written using this code, so you have access to everything that you could want here. And of course, it helps me out if you star the repository, watch the repository, and follow me on GitHub. I would appreciate all of that. So this is the kind of the outline for the model down here. So the first thing, I have data going back to 2011. You don't want to train it on everything. Specifically, things like low volume stocks aren't going to be good for a model because you can't scale it up. You also, there's a larger slippage in those because there's a bigger bid-ask spread. So you want to kind of isolate stocks that are good for a universe. So I've done that. I've gone through several iterations of that, but I have a really good universe now. It only contains common stocks, real estate investment trusts, and ADRs. And it's filtering out everything except for the top by volume, filtering out things that have dropped over 50% in the last year. I'm then using this universe as input to train a returns model. So you want to predict things like returns relative to the market, returns relative to sector. I'm actually looking at Sharpe ratio relative to the market. And then once you have a good returns model, you need some portfolio strategy to implement buys and sells accordingly. And the portfolio strategy should be stable and reliably. This is where this comes in. So the portfolio strategy should reliably return 18 to 24% per year. So here's my model that I'm confident in. Here it is right here. So why am I confident in this? First off, I'm looking at these metrics. So the first metric is the information coefficient. I'm shooting for a value above 0.01 to 0.02. And here I'm getting 0.04, so that's really good. The standard deviation of the information coefficient should be somewhere between 3 to 13 times the information coefficient. It's 3 times the information coefficient, so that looks really good. The information coefficient to information ratio on a daily basis and a yearly basis I'm looking at. I forget what my goal is for the daily one, but the annual one I'm shooting for 0.3 and I'm getting 2.2, so quite a bit larger. And the t-statistic I'm shooting for 1.95, I believe, and I'm getting 3.75. So I'm beating all the metrics I'm looking at by a fair margin. The first one, information coefficient, is basically evaluating the predictive power of the model, and the other ones are evaluating the stability of the model. So this indicates the model is both stable and powerful on this training set. So this is training from 2011 to 2018, validating on 2018 to or I think 2019 to about 2022 sometime, and then it's testing mid 23 through the beginning of 26. So this is the decile analysis. So the first reason I'm confident is because it's hitting all my metrics. The second reason I'm confident is because this decile analysis looks really good. Basically, it should the bottom decile, bottom 10% should be the lowest prediction. Top 10% should be the highest prediction, and it should increase monotonically. So each decile should be higher than the previous, and that's exactly what we see here. So I'm confident in that as well. Finally, when I do a walk forward analysis on this, so the previous was just using one test training split. This is using a different test training split for every single year and training it. So if it's a good model, it should still be hitting the values every year. And you can see here that it is. Here's a better analysis. So this is more metrics. And you see that it's really good on every year that it's testing. So I have a really good model. What I need to do now is implement a good portfolio strategy for this. That's what I've been working on. And I've been having trouble doing that. So this looks really good, but there's data leakage. Same thing here. This is a good model, but it only works post 2023. So it only works on that first model that I showed. And on the walk forward here, I'm going back to 2016. So I want to make sure that this is working well. The model itself is good. So I need a portfolio strategy that works well going back to 2016. And this kind of highlights the issue here. So this is the strategy that I just showed, which is working well. So this looks really good. It's giving 40% average annual return, and the worst drawdown is under 10%. So, and if you look at the rolling sharp here, it's basically positive the whole time. However, when I implement this going back to 2016, you can see, so this is starting in mid 23 and it's doing really well. Going back to 2016, however, it gradually declined and then did well post 2022. And really post 23, in 23 is when it started to take off. So this strategy seems like I'm going in the right direction, but I want something that works going back to 2016, not just going back to 23. Now, the key reason for this, I believe, is the dispersion of the universe that I'm using. So you see that this really changed in 2020. It went from a dispersion mean around maybe 1.8 or something like that. And here it jumped up to well above 0.02. And so the question for that is, why did that happen and how do I incorporate it into my model? These are all using rules-based backtests, so basically scaling down the leverage here. You can see in the bottom left, it's scaling down leverage based on the drawdown and based on the volatility. Yeah, so this model looks really good, but I need something that works well going back to 2016. If I'm really not able to do that, then I can just go ahead with the return since 2023. And basically with the conclusion that something changed here in the market, but this is a much less robust strategy, and I won't be nearly as confident in this. If I'm returning money consistently going back to 2016, then I can be really confident. So this is looking at the decile analysis for each model going back to 2016, and you see that it's gotten better over time, but it's basically showing the results I want. The bottom decile is lowest, top decile is highest. So I need to look into that. Now, probably the reason it's working so well, like if you look here, the scale is from minus 0.15 about to 0.1. And here it's a lot lower. So from minus 0.06 to 0.04. And so maybe that's the reason. Maybe there's been a better spread more recently. That would go in line with the dispersion thesis. And here's some more portfolio strategies I tried. So I was able to kind of improve things if I'm smoothing out predictions. I also improved things. Wait, what is this? Smoothing predictions. This is smoothing scalar. I don't remember what this is looking at. I should have taken better notes. And then I added hysteresis. So this is basically saying don't just drop something out because it's barely dropped out of the top n number of longs or shorts that I'm picking. Drop it out when the thesis breaks. And basically this should reduce the turnover ratio. Because I basically concluded part of the reason I was struggling getting good returns since 2016 was because the turnover was too high. So what I'm going to be doing today is, I forget what it's called, hierarchical risk parity. This was suggested by a viewer, and then I found it in my book here. This book is Machine Learning for Algorithmic Trading. So I bought this several years ago, so it's not that new anymore, but let's see when this is from. So, this is from 2020, so it's not that old. It should show the print date in here. I think I bought this around 2023 or so. Yeah. No, it doesn't. Anyway, so now I'm going to be working on implementing this. So, basically, this should be a better portfolio strategy, and I'm hoping this will be able to squeeze out positive returns going back to 2016. So, let me pull up Claude. I'm using Claude and Google Gemini Pro. Alright, so hierarchical risk parity. It leverages unsupervised machine learning to achieve superior out-of-sample portfolio allocations. A recent innovation in portfolio optimization leverages graph theory and hierarchical clustering to construct a portfolio in 3 steps. So this is Lopez de Prado's strategy, which we've looked at before but haven't implemented. So step 1, define a distance metric so that correlated assets are close to each other, and apply single linkage clustering to identify hierarchical relationships. So what is a distance metric is my first question. What is a distance metric in hierarchical risk parity? And of course, please subscribe, please like the stream, that stuff helps me out. If you're interested in using this code for yourself to create a similar model, or if you watch the streams enough, you could create the same model I'm using. Check out the GitHub, the link's in the description, and you can build a model. The model I have that is performing really well, I write in under 100 lines of code. So this is pretty efficient, so go try it out. It helps me out a lot if you star the repository, watch the repository, and follow me on GitHub. So a distance metric in HRP, hierarchical risk parity, converts correlations between stocks into a measure of how different are these two stocks, so that the clustering algorithm can group similar stocks together. The problem it solves, hierarchical clustering needs to know the distance between every pair of stocks. Correlation tells you similarity, but clustering algorithms need different distance. You need a function that converts one to the other. The most common in HRP and what de Prado uses is the distance is equal to the square root of 0.5 times 1 minus the correlation of the two. That's pretty easy. Where rho is the Pearson correlation between stock I and stock J's returns. So do I want to use the correlation between the returns or the correlation between the Sharpe ratios? The predicted Sharpe ratios. A simpler formula like 1 minus rho satisfies, so the formula isn't arbitrary. It's a proper Euclidean distance metric, meaning it satisfies 3 mathematical properties. A stock has 0 distance from itself. Distance is symmetric. So yeah, the distance between A and B is the same as between B and A, and the triangle inequality holds. What is the triangle inequality? Which prevents the clustering from producing nonsensical groupings where A is close to B and B is close to C, but A is far from C. Oh, okay. The clustering step, so how it flows: returns matrix, correlation matrix, distance matrix, hierarchical clustering. Hierarchical clustering. That's kind of a mouthful. Quasi-diagonal reordering, recursive bisection. So the clustering step groups stocks that are close together. Do I have my headphones here? No. But they should be somewhere. There's one headphone. See if it's charged. Nope. Okay, I'm going to charge this for a bit. Clustering step groups stocks that are close together into the same cluster. Then recursive bisection allocates less total weight to correlated clusters. If 10 text stocks cluster together, the entire cluster might get 15% of the portfolio rather than 10 times individual allocations. For your strategy, the standard is the right choice. The alternatives offer marginal improvement in specific edge cases. So, okay, step 1, define a distance metric so that correlated assets are close to each other, and apply single linkage clustering to identify hierarchical relationships. So what is single linkage clustering, and how does it identify hierarchical relationships? So, single linkage clustering defines the distance, It's the most permissive linkage method. Clusters merge as soon as any two of their members are nearby. Uh-oh, internet's slowing down. I need something. Let's look at the, what's it called? Activity monitor. Network. Well, seems fine. The hierarchy. What the hell? Complete linkage. Distance between clusters is equal to maximum distance. Single linkage tends to produce elongated chain-like clusters. Doesn't cut the tree at fixed height to create flat clusters. Instead, it uses the full tree structure for recursive bisection. What is recursive bisection? Why is this going so slow? Divide and conquer strategy used to partition a graph into p smaller balanced subgraphs by recursively splitting it into two equal-sized halves. It's a widely used heuristic for optimizing graph partitioning in parallel computing, loading balancing, and sparse matrix ordering. Okay, so step one, define a distance. So the distance is the Euclidean distance, root of, I think, 1 minus, root of 1 minus root of 0.5 times 1 minus rho of ij. So that makes it a triangle, basically. Define a distance metric so that correlated assets are close to each other. Okay, so I want to derive the distance metric from how close the returns are to each other, or on how close the predicted Sharpe ratios are to each other. Returns, here's why. What HRP is solving. Given the stocks I've selected, how do I allocate weight so that no single correlated group dominates my risk? Prediction correlations. Alright, so how do I allocate weight so that no single correlated group dominates my risk? Prediction correlations answer a different question. When the model likes stock A, does it also like stock B? This conflates model structure with market structure. Your model uses the same returns, same features for every stock. Stocks with similar feature profiles will naturally get similar predictions. Well, if the feature profiles are the same, it seems like they're correlated in some way. Two stocks might both have high momentum and low volatility. Your model scores them similarly, but one is a defense contractor and the other is a utility company. Okay. Well, okay. Combining both into a single distance metric muddies both purposes. There is one scenario where prediction correlations matter. Monitoring whether your model is producing diversified signals. If predictions for 40 of your 50 longs are highly correlated, your signal has low effective breadth. You're making one bet repeated 40 times rather than 40 independent bets. Useful diagnostic. All right. So, number 2, use the hierarchical correlation structure to quasi-diagonalize the covariance matrix. I don't know what that means, really. Step 2 of implementing hierarchical risk parity involves, quote, I'll just say is, quote, use the hierarchical correlation structure to quasi-diagonalize the covariance matrix. Reordering the rows and columns so that correlated stocks are adjacent. It's a sorting step. The recursive bisection. Apply top-down inverse variance weighting using a recursive bisectional search to treat clustered assets as complements rather than substitutes in portfolio construction and to reduce the number of degrees of freedom. I have a model which predicts the Sharpe ratio over the next 5 days. It seems as though hierarchical risk parity does not need the results from my model. What is the best practice for incorporating an ML model which predicts Sharpe ratios into the HRP portfolio strategy? My goal is to develop a robust portfolio implementation method for the results of my model. Hey, lo-fi music boys. Yeah, give me a sec. Let me put in this prompt. So why do I want to incorporate tilt? Isn't it better to use my model to pick longs and shorts and then use HRP to allocate capital. Oh, thanks. That's helpful. I was messing around with the audio earlier. Hello. Let me look at properties. Hello. Hello. Did that change anything? Let me try turning up the volume on, oh, not desktop. Let me try doing it on my mic. Maybe this will help. I don't know. Let me know if this is any better. I guess I'll put it at 5 decibels. Let's see. Let me know if that sounds any better. Okay, good. So this is the kind of my goals. So first I'll start with my goals. So the first goal is to beat the S&P 500 by a significant margin. So the S&P returns on average 6% per year. I want to average 3 to 4 times that, so 18 to 24% per year. Hey Gilb, thanks for the input. I do minimized YT and then suddenly well, good. Okay, I'm coming through good then. So the S&P returns on average 6% per year. I want to, so you could just buy and hold the S&P until the United States crashes, and you should be good. 6%, that's better than a bank. If you put your money in a savings account, that'll be the savings account. I want to do better than that. I want to generate 18 to 24% per year. And this is my strategy to do that. Now, I'm writing all of this in Python code, so I have a secondary strategy, which is to create a usable tool so that anyone can create these models for themselves. So I have this on GitHub, so if you're interested in that, go check out the GitHub for this project. It's here, the link's in the description. Download it, try it out for yourself, and let me know how it goes. You could let me know in the Discord link, which is in the description, or just tune into the stream and let me know here. It helps me out a lot if you star the repository, watch the repository, and follow me on GitHub, because that helps raise my coding profile. So those are the two goals. So this is the outline of the model. First, I have data going back to 2011. I found a really good, I should say I have a I have a constraint on the second goal, which is that everything should be free. So there are tools to do all sorts of things, but lots of times they're expensive. Lots of times you need a really good data source, and you're going to have to pay for that. I was lucky to find a good free data source. And so all the data that's going into my models and the strategy, at least for now, while I'm not making money and I don't have not making money on the stock market and don't have a lot of capital, I want everything to be free. If I get good at this, then I can start paying for stuff. But that's kind of a big requirement for me personally. If I want to use something, I want it to be free. So that's the constraint I've placed on it here. So the free data source I found, there's a link in the description. You can find instructions for installing it on my GitHub. But it goes back to 2011. So the first step is isolating a stock universe, because your stock universe is basically what your model is going to train on and make predictions on. So you don't want to use everything that's available. There's a lot of junk stocks out there. So penny stocks, low volume stocks you don't want. Low volume stocks, the problem is there's a high spread between the bid-ask spread, and there's a lot of slippage involved. Also, they're less predictable. And if I scale my model up and I get people to invest in it, quant firms, or if I start my own hedge fund or something, I need something that's going to be able to scale to really high volume. If you're buying stocks like Apple and Tesla, you're going to be able to scale it up. If you're buying penny stocks, that's not scalable, or really things that have low volume. So I'm filtering out a stock universe. An example of a stock universe would be like the S&P 500 or something like that. That's a very simple example. The problem with the S&P 500, I tried using that as a stock universe, and they don't make their data easily available. You could see what's currently in it, but it's hard to find data that goes back, to 2011, and just train it on the S&P. So I've isolated a stock universe. The stock universe I'm using is common stocks, real estate investment trusts, and ADRs, which are foreign companies that are listed on the US stock market. The next step is to create a returns model. So I wanted to predict something like returns relative to the market, returns relative to sector, probability of a positive return. What I eventually landed on is predicting the Sharpe ratio over the next 5 days. I got a really good model with that. I'll show that in a sec. And then once I have a returns model, which is now, so now I have a really good returns model. The next step is figuring out how do you make money off of that? How do you allocate capital based on the output of the returns model? So that's what I'm working on now. And that's this portfolio model level. So here's the model that I have. And I'm really confident in it for the following reasons. So first of all, I'm looking at these metrics at the top. Ignore RMSE and directional accuracy. I'm interested first and foremost in the information coefficient, so that's the predictive power of the model. The stock market has a really low signal to noise ratio, so it's very noisy. And so I'm shooting for an information coefficient of 0.01 to 0.02. I'm getting an average of 0.047, so that's really good. And these next four metrics are telling me the stability of the model. So the standard deviation of the information coefficient should be 3 to 13 times the information coefficient. It's roughly 3 times the information coefficient, so that's good. The annual information coefficient to information ratio is about 2.3. I'm shooting for 0.3, so this is way better than I'm shooting for. And the T statistic, I'm shooting for 1.98, and I'm getting 3.8. So this looks really good for those reasons. Secondly, it looks really good. So this is a model it's training from 2011 to about 2019 or so. It's validating, so tuning the hyperparameters of the model from 2019 to about end of 2022, and then it's testing on mid-23 through the beginning of 26. So this is what the decile analysis looks like. The decile analysis is basically you split the data into deciles. Your bottom decile should be the worst performing, top decile should be the best performing, and if it's monotonically increasing in between, you're good. Monotonically increasing means each decile is higher than the previous decile. So all of that I'm seeing here. So not only are the metrics good, the decile analysis looks really good. Finally, if I look at the performance over time, so if I do a walk forward analysis and look at the metrics, you see that here. You see it performs really well on every single year of the data going back to 2016. So my information coefficient is above 0.01 every single year. The information coefficient to information ratio is well above 0.3 every year. And the Sharpe ratio is well above 1 every year. So now I'm really confident this is a good model. This is the decile analysis for each model in that walk forward. And so it's not perfect. You see in early years especially it's struggling a little bit, but the characteristics are good. So the bottom 10% is always the lowest. The top 10% is always the highest, except for here. But generally this is showing this is a really good model. So now I'm on the portfolio stage, and I've been going through different portfolios to get work that I can get to work. And here's basically the problem I'm having. I have a really good strategy if I test on the initial model I found. So going back to 2023, you see the returns are really good. Here's an example. So I'm getting 300% returns over, what is this, 2.5 years. That's really excellent. And the worst drawdown I'm having is under 10%. So that's really good too. And the rolling Sharpe ratio over 60 days almost always is positive. So that's really good. Also, if you look at monthly returns, there's lots of green, just a little bit of red. There are some concerning things here. First and foremost, the biggest drawdown is recently. The worst month is recently. And so I need to look more at this to see how can I squeeze out performance. The most concerning thing is when I do this on the full walk forward analysis, you see that it's giving negative returns from 2016 all the way until end of 2021 when it starts going positive, and it doesn't really get good until about mid 2023. So this region here. And so this I'm not very confident in implementing because it would have been really bad 2016 to 2021. Even though the annual return is still double the S&P 500, all of that good performance is really post mid 2023. So I need something more robust. And you can see here the dispersion of the market changed in 2020. So it became significantly more dispersed after 2020. And I think this is the reason that that the model's performing well post 23. But I need to look more into this. And so I've been doing different portfolio strategies, trying different methods to squeeze out a positive return from 2016 to 2021, and none of that's working. So I'm trying something a little bit more advanced now, hierarchical risk parity, which is a portfolio strategy. It came out in a paper by Marquez Lopez de Prado, something like that, in 2016. So that's what I'm trying to incorporate here. Can I use that for my portfolio strategy to get returns, positive returns on all years? So that's what I want to do now. So it's telling me to use the model output to tilt the weights from Lopez de Prado's strategy. And I'm wondering why. Pure HRP after selection is probably okay. Good. So good intuition by me. The model predicts cross-sectionally z-scored Sharpe. The decile analysis shows strong monotonicity across the full distribution. Yep. But within the top 20 stocks out of 500, you're looking at the difference between the 96th and 100th percentile. That's really going to be the 98th and 100th percentile because I'm using 1,000 stocks. Look at your decile charts. The bars show clear separation between decile 1 and decile 10, maybe 0.15 in spread, but within decile 10, the difference between the best and worst stock is a fraction of that. Yeah, the model reliably says tilting by prediction magnitude within your selected group assumes that within decile ranking is informative. If it's mostly noise, the tilt just adds concentration risk. Every selected stock has passed the same bar, top N in the universe. HRP then ensures that correlated selections don't dominate risk. The stock gets more weight because it provides unique diversification, not because the model gave it z-score 2.8 instead of 2.3. The approach makes the minimum number of assumptions. When tilt, okay, I don't care about tilt. So, okay. Outline the structure for building a new portfolio class, a new class in portfolio.py for implementing the HRP allocation strategy. Don't don't write any code yet. Let's just go over the high level structure. What it needs at initialization. Same inputs as managed backtest. Plus one new parameter. Look back for the covariance estimation window. It needs to compute daily log returns, the run method, what happens at each rebalance, select stocks, same as manage backtest, slice trailing returns for the selected longs, pull the last look back day, same for shorts. This gives you two small data frames to compute covariance on. Compute correlation matrix. Run HRP on shorts, same process, independent from longs. The short side correlation structure is different from the long side. Stocks you're shorting might cluster differently. Apply exposure and signs, multiply long weights by long side. Okay. Should be a set of standalone functions, not methods on the class. 3 reasons. You can test them independently, you can reuse them. Okay, so first, write the file. So you're trying to train a model specifically on S&P 500 and not algo trading to trade in market. No, I'm not training on the S&P 500. I'm training on my own universe, which I've defined. It should be correlated to the S&P 500, but I have 1,000 stocks in the universe, and it's implementing this logic. Universe Explorer. Yeah, so this is the logic. Universe 7 is the what I'm using. So first I'm dropping out all ETFs from the universe. I'm then doing security type filter. I forget what that did. It's like getting right. It's security type filters, getting common stocks, ADRs, and REITs. Then I'm getting the top 2,000 by liquidity. Then I'm trimming out everything that has less than $5 a share. And then I'm dropping out everything that's crashed over 50%. That's basically my universe. Or that's exactly my universe. So not the S&P 500, but it should be correlated to the S&P 500. Okay, I'll be right back. I'm going to go see if I could figure out where I put my headphones. Because these Bluetooth ones suck. I'll be right back. Oh. And I found my headphones. They were on the floor. So I'm going to put some music in. Don't forget to like and subscribe because that helps me out a lot. If you're interested. If you're not interested, of course, don't do that. And give me some music recommendations. All right. So, okay, come on, hurry up. Wow, this is taking a while. Not the most interesting thing to watch. What do I usually listen to? All sorts of stuff. Right now I'm listening to Katy Perry, the one that got away. I like really all music except for jazz. And I don't really like metal very much, but some songs are fine. I like rap a lot. I like pop music a lot. Country music I like a lot. Um, Indie music, they call it, although I think that's pretty poorly defined. Yeah, I don't know. Oh, oh man, this is taking a while. Okay, I'm gonna go get a drink really quick. I'll be right back. Let's go back for old time's sake. All right. Man, this is going to use up a lot of the thinking I get from this model. Okay, first we have HRP. Pretty Blur by Jonah Z. Okay, very good. Thanks. Let me look it up. Pretty blue. Oh, pretty blur. Okay, test one. Distance metric properties. Verifies mathematical foundation. Blah, blah, blah. Okay, good. Quasi-diagonalization. Creates synthetic returns with 3 known clusters. Recursive bisection weights. Verifies outputs are valid portfolio weights. Okay. Okay. Man, why is this going so slow? Stock market tool. Okay, so let's run that test now. Oh, I shouldn't put that in scripts. It should go in tests. Okay, then let's see what's that look like. Yeah, I liked that song. That was good. Okay. Correlation raw order, correlation quasi-diagonal. So it should group close things to each other. I mean, this is Apple, Microsoft, and okay, so that's not really a good test. I don't know. I think it's working though. Let's look again. Says all tests passed. I'm gonna go ahead with this for now because I don't have many requests. You gotta find another way out. Don't be so down. Come on, young homie. You'll be okay. You'll find real love. Alright, actually I could pop over to Google AI Studio and let's go to Gemini Pro. Alright, so I have this code which uses, oh, let me switch to my other user. Okay, so I have this code which implements the functions necessary for incorporating hierarchical risk parity into my portfolio strategy. This is hrp.py. I want write a class which uses these functions to incorporate hierarchical risk parity into a portfolio strategy inside of portfolio.py. I want the class to work in the following way. 1. Define the portfolio to use of type portfolio to use. Define the get predictions from the portfolio using the same logic as managed backtest. Top n longs/shorts or top percentage longs/shorts. Okay, so then get predictions from the portfolio. Scale to define the stocks to long/short. Use HRP on the longs/shorts to determine how much capital to allocate to each. No, I really know coding. I don't really know much about trading. My coworker says I need to become the master of trading before I can really make a model which works. But I've already got a model which is predicting Sharpe ratio as well. So I think I can kind of plow forward with that. And I have this book at my disposal, Machine Learning for Algorithmic Trading. So I don't know, I'm hoping I can squeeze enough information with that stuff. Use HRP on long shorts to determine how much capital to allocate to each. Do not incorporate any other risk management techniques which are in the managed backtest. Call this class HRT. I don't care what you call the class. Alright, so let's see what it gives me. Hopefully I could get something that works for hierarchical risk parity, HRP. Oh, shit. I gotta give it the code. A worthy effort, thank you. HRP and portfolio. Did I say I have a model? I have a model which is successful at predicting the Sharpe ratio over the next 5 days. The new class should output the same plots as managed backtest. Also, add a new column or columns to the plot which shows plots which are relevant to the HRP strategy. Okay, so this is gonna think for a while. So, I guess I could read more about hierarchical risk parity with machine learning model. What advances have been made to portfolio strategies since DePrado came out with what's it called? HRP. Hierarchical risk parity. Question. Hierarchical equal risk contribution, which improves cluster allocation, and modified HRP methods using shrinkage estimators. Okay, so we've got a class now. Okay, let's see how this does. Need a new song to listen to. Oh man, what should I listen to? You haven't. The real one's far too mean. The watered down one, the one you know, was made up centuries ago. Alright. Test HRP, so we want portfolio. Whack and corny. Yes, it's awful, blasted, boring. Twisted fiction, sick addiction. We'll gather round children, zerp it, listen. Alright, so explain how the code works line by line. So let's see if we can understand this implementation. So the first step that should be happening is first define a distance metric so that correlated assets are close to each other. So is it using the Euclidean distance metric? Alright, I have Spearman R, I have map, yeah, I got everything else there. But I need to bring in the functions. Broke as Spanish, me no hablo. In that diablo, we found bravery in his bravado. Need to listen to the models. You ain't got no fucking Yeezy and Serato. Stupid, but what the hell do I? Initializes the class. It takes your standard parameters, number of long shorts, good, holding period, cost BPS, HRP lookback. That's something I might want to change. So this is using 60 days. Hey, Sir Night Night. How's it going? I'm back home. Finally. We on a truest. Hey, teacher, tell me, how do you respond to students? Since model predictions are typically generated using close prices, trading on the day's next open. Yeah, duh. Oh no. Wrong assumption. On step 2, you make an incorrect assumption. All features in the model are lagged by a day to prevent look-ahead bias. In a Chrysler LeBaron. All features in the model are lagged by a day to prevent look-ahead bias. So the close for a day is not the close, is not used in the prediction. Look like a fat booty Celine Dion. Calculates open to open log returns since model predictions are typically generated. Okay, so we've covered that. Crucial step for HRP. It expects a matrix where rows are dates and columns are stock tickers. Pivot table converts the stacked long format data frame into this wide matrix. We recompute this here so we don't have to rebuild it every single day. Yeah, obviously. Add an option for smoothing. This should be a Boolean flag. I want to be able to turn this on and off. So the core backtest loop run. This loop calculates walk forward through time by each day. Daily portfolio gross return equals 0. If date is in there and current weights, returns is equal to, so if we have weights and we have the date, returns are this times, get the P&L column. Daily portfolio gross return is sum of weights times each symbol, so the weights for each symbol, for symbol weight and current weights. Before doing any trading today, we check out. Yeah, okay. I will never, ever let you live this down, down, down. Triggering rebalance. Checks if today is a trading day. Okay, so only rebalances if it's a rebalance day. Stock selection and hysteresis. Add the hysteresis. There should be inputs which turn the hysteresis on and off. Oh, Sir Night Night, I'm incorporating finally the thing you told me like several weeks ago, hierarchical risk parity. I'm finally adding that into the portfolio model, but now I have a good machine learning model. That's kind of the basis for this. So now that I have this, I can now do hierarchical risk parity. DePrado, our hero. There should be inputs which turn the hysteresis on and off, and also which calculate the buffer multiplier. Tell me if these can be implemented with a single input. Okay. If we want, okay, so that's hysteresis, right? Yeah. Applying hierarchical risk parity. To run HRP, we find today's index and the returns pivot and slice out the previous 60 days of historical returns. It stops at the current date, ensuring no look-ahead bias. When incorporating HRP, update the method, since you should update the logic. Since you should be update the logic since you should be since you shouldn't be moving the target forward by a day. The first thing I mentioned. So then we get historical returns of the stocks. If a stock traded perfectly flat over the last 60 days, HRP math breaks and drops the stock. Instead of losing our AI's prediction entirely, we assign drop stocks an equal weight. Does the equal weight for dropped stocks fall at the bottom of the importance, i.e., will this have the lowest weight? If not, rewrite so that these will still be traded but do not have the lowest weight. Calculates effective N, measures diversification if you hold 20 stocks, but HRP gives 90% of the capital. We apply HRP to the long bucket and short bucket independently. Yeah, obviously that's what should be happening. So effective N. These are saved to verify that HRP is actually diversifying the portfolio. Is it the case that effective N is not used to change the weights? If this is not the case, tell me why. We apply HRP to the long bucket and short bucket independently. That should be good. Dollar neutrality. If target gross exposure is 100%, and we have both longs and shorts, side allocation becomes 0.5. Yeah, that's good. Multiplies the HRP weights, which sum to 1, by the side allocation to get portfolio weights. That sounds good. Calculates the absolute. Okay. Make sure that shorts are sized, accounting for 150% margin required to hold the positions. Because I want to remain market neutral, and account for this, the shorts should receive more total capital so that market neutrality is ensured. More specifically, metrics and plotting. That's all good. Alright, so the standard plotting function is expanded to 4 rows. Don't expand the plot to 4 rows. Instead, add a third column with the HRP plots. Okay, let's say this whole thing again, and then rewrite the class. And in a world scene, and in a world scene, and in a 21st century, it gets so loud. Powers, Austin Powers, lost in translation with a whole fucking nation. They say I was the abomination of Obama's nation. Well, that's a pretty bad way to start a conversation. At the end of the day, god damn it, I'm killing this shit. I know damn well y'all feeling this shit. I'm on my own dick. How ye doing? I'm surviving. Okay, so it's writing the code, then it's going to give me an explanation. Hey, 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 hey. Now this would be a beautiful death. Jumping out the. You're completely right. Yeah, I know I'm right. I've reverted the return. I hate how it does that shit. What I was asking it something about work, and it made some mistake, and it said I owe you a direct and sincere and massive apology. It's not very necessary. Just give me the new logic. Jumping out the window, letting everything go, letting everything go. World scene, in a world scene, in a world scene, world scene, world scene. Okay, smoothing and hysteresis toggles. Smoothing toggle added smooth predictions as a Boolean if true. Added buffer multiplier, yes, this acts as a single input. If you make it 1, we're good to go. Dropped stocks waiting. In the previous code, stocks dropped by HRP. Yeah. Now the script checks if any stocks were dropped. If so, it looks at successfully clustered stocks. Good. No effective n is not used to change weights. Good. 150% margin. This required careful math to be market neutral. You must have equal dollar exposure on both sides. Careful math. If you deploy $40 to longs, you just consume $40 of buying power. If you deploy $40 to shorts, yeah. Want you to see everything, want you to see all of the lights. Alright, so let's delete this HRP class. If you want it, you can get it for the rest of your life. If you want it, you can get it for the rest of your life. Something wrong. I hold my head. MJ gone. I'm dead. She called the feds. I'm almost there. I'm on my way up the stairs. All of the lights, all of the lights. Grandmother hate me in that order. Public visitation. We met at borders. I'll be more supportive. I made mistakes. I hold my head. All of the lights, all of the lights. 20 long positions, 20 shorts, rebalance every 5 days. Oh yeah. Holding period is 5. I want to hold for 5 days, but I also want to trade every day with a tranche which consists of 1/5 of the total portfolio value. Is this the logic which is being implemented? Don't write code, just give me an answer along with an explanation. Turn up the lights in here, baby. The current logic relies on the line. If your holding period is 5. Okay. Add a new argument for rebalance days. If this is 5, use the same logic which is currently implemented. If this is 1, use the tranche strategy. For other values, adjust the tranche size accordingly. From the holding period argument, rewrite the class. Everybody knows. I need to see your fucking hands at the concert. Profit, profit. Everybody knows I'm a motherfucking monster. Call it Malibu, yeah. My presence is a present, kiss my ass. All right. So now inside of the back test, run. Good. This is simpler. It just takes one argument for 1. Buffer multiplier, smooth predictions, rebalance days. All right. So now let's add rebalance days is equal to 1. Okay, and then what's the code for implementing this? Results equals that, then plot. Okay, so now let's do Python 3 Portfolio Explorer. Okay, and let's see how this works. Wait, I'm the rookie? And then I can go through and see, does this improve? So let's add a slide here. Portfolio performance using HRP to weight the selected longs and shorts. I guess if I do top N%, that shouldn't change anything. It'll be the same. I lost the line, and I'll let God decide. So I am headed home. I cross the line. So I'll let God decide. What's today? The 19th? I'm headed home. This is taking a really long time. It's going to be hard to rapidly iterate. Hey, NGK. Well, I think I'm getting there. I have some portfolio strategies, but they're not working well. And basically, the big problem I'm having is this. So the first model I'm building, which is training 2011 to 19, validating later. Here's the plot I just got. Training 2011 to 2018, validating on or 2019 or so, validating on 2019 to about 2022 at some point, and then testing on mid 23 to 26, beginning of 26. This is performing really well. So 300% returns over 2.5 years. The worst drawdown is under 10%. The Sharpe ratio is positive almost the whole time. There's only 1, 2, 3, 4, so 6 months during that whole period are returning negative. That all looks really great. The annual return is 40%. It's basically awesome on every metric. But then when I extend this back, so I have the simple portfolio strategy, which is one model that I'm testing here. And then when I do the walk forward, I get different models for each year. And so when I try the same strategy using those walk forward results, you see it basically goes negative until 2022. So it's only really performing well on about this region. And that's what I need to figure out. Because if it had, this performance looks really good, but since it's failing 2016 to 2020, even though the model's still performing really good over that time period, which you see here, this makes me not confident in the model. So I want something that's performing well on basically the full data that I have access to. So I'm trying to get something which fixes that. And here's the results using hierarchical risk parity, and it's not great. So, kind of same thing. It's getting negative until early 21. But the good thing is that I have some better things to look at. So, some things I've already found. So I looked through and I found some things which are increasing the performance on a simpler back test without using hierarchical risk parity to weight things. So I'm going to try incorporating some of these right now. So the first thing we can do is increase. All right, so let me actually document this first. Love the roof, love war, fuck a truce. In bed with Mother Goose. Okay, so first thing, change rebalance days to 5. Okay, is there any way I can speed this up? Was my next question. Tell me why or why not. And explain, but don't write any code. I, of the law, aspire for more. Them kilos game we gave you Bobby Brown jaw. I own you all. One hand in the air if you don't really care. If you don't really care, it's like that sometimes. The shit ridiculous. Like that sometimes. One hand in the air if you don't really care. Pandas inside a daily loop. Okay, well, I'll run that next. Oops. No, did I? Shit. Really? Alright, well, I'm going to change this back to 1 because I need to document it. Let's look at the other things I can change. So it says I can speed it up, but extracting only the 40 selected stocks. The slow down is because I'm using pandas, not numpy, but pandas is relatively optimized, so I don't know, I'll leave it for now. Let's time this to see how long it takes, so I'm just going to time it on my watch. First for the mistress. You know the shit is fucking ridiculous. Alright, so I'll add a minute. Oh, okay, yeah, it's running. I'll add a minute to it because maybe this has been going for a minute or so. And then other things I can do. End longs, end shorts. So I could change that to be just 10 of each. Rather than that, if I do the top 10%, yeah, that should be the same regardless of the distribution. So what if I change the look back? So let's see here. Here they're optimizing it. Alright, how do they define you look back? Oh, let's just look for conclusions. Put your hands to the constellations. The way you look should be a sin. You're my sensation. To the congregation. Lot from Satan. Satan, Satan, Satan. May the gods be with us in that magic hour. I need good Christians, make rash decisions. Oh, she do it. Oh, she lose it. Text message breakups, the casualty. Yeah, this is what I don't understand. It seemed this was in this book I'm reading, and it's here. The MVP mean variance is actually outperforming hierarchical risk parity. So, that doesn't seem good. Mean variance, hierarchical risk parity. Okay, so HRP is way better. The summary of backtesting results, HRP portfolio. Yeah. Oh, so this is on one sector, IT sector. So it's not the case on the pharma sector. It is the case on IT. Sun goes down. It's a magic hour. The magic hour. You got green on your mind. I can see it in your eyes. Why you standing there with your face screwed up? Don't leave while you're hot. That's how Mace screwed up. Whole rank screwed up. Pray for us. I hit the Jamaican spot at the bar. Take a seat. I ordered the jerk. She said you are what you eat. But tonight you should have seen how quiet the room was. The Leah Cone, the DR own. That's Leah own, not Rhea, homie. Could it be more Tony? You love me for me. Could you be more phony? Put your hands to the constellations. The way you look should be a sin. You my sensation. Alright, so what if I change this to 5? Does this improve performance? Cat got your tongue? Alright, so let's make this its own section. I'll just call it HRP. Hierarchical risk parity portfolios. So I'm doing this from 4. Oh, that only took 4 minutes or so, so not bad. 4/19/2026 to sometime in the future. Okay, so if I change the rebalance to be every 5 days, it's still performing poorly until the end of 2018, but then it starts doing a lot better, and it does really well over 2019. So that's the first time I've done well over 2019. So that's an improvement. Gross exposure is stuck at 0.8. Is that the case here? Why does gross exposure change? It's only deviating slightly from 0.8. Alright, so that's a question to answer. Cherry red chariot. Excess is just my character. Daily turnover is pretty high, but should obviously be less than rebalancing every single day. Does 5-day rebalancing improve results from previous slide? Question mark. I guess I could put them both in, then I could put a conclusion in. So obviously the drawdown should be less, or turnover should be less, 0.32 to 1.6. So that's really good for turnover. It still went down during this period, but not as much as before, and then it turned it around. Drawdown was worse. Diversification hovered around 10. Same thing here. Concentration, same thing basically. But the gross exposure was different, so that's kind of interesting. Alright, so what's the next thing to try? Does fewer long shorts improve HRP strategy? Question. So I think it's time for us to have a toast. Let's have a toast for the douchebags. Let's have a toast for the assholes. Let's have a toast for the scumbags. So first let's try 10. Baby, I got a plan. Run away fast as you can. Pictures in my email. HRP tranche. Okay, good. So I still have the backtest results. So let me put that in real quick. At least you know that's what I'm good at. And I always find something wrong. You've been putting up with my shit just way too long. Get the current ones. Let's run that again. Baby, I got a plan. Run away fast as you can. Run away. And if that to get crazy, run away. Baby, I got a plan. Run away fast as you can. Run away from it, baby. Run away. Run away from it, baby. Run away. And if that to get crazy. Basic strategy. So let's call it basic strategy. 1 day rebalance. You can leave or live with it. It could buy a dream with that motherfucking top off. Back to wearing knockoffs. I had knock it off. Neiman's chop it off. Let's talk over my ties. Waitress top it off. Hoes like vultures wanna fly in your Freddy loafers. Oops. Okay, let's put another label over here with 5 day rebalance. Never was much of a romantic. I could never take the intimacy. Okay, so now we're seeing basically the same thing as before. If I decrease the number of shorts and longs, we're getting better performance. Drawdown's about the same. Turnover, I think, is slightly less. You've been putting up with my shit just way too long. I'm so gifted at finding what I don't like the most. So I think it's time for us to have a toast. Let's have a toast for the douchebags. Let's have a toast for the assholes. Let's have a toast for the scumbags. Every one of them that I know. Let's have a toast for the jerk-offs that'll never take work off. Baby, I got a plan. Run away fast as you can. Alright, and then let's try 5 longs and shorts. Now, I might be squeezing better returns out, but I'm not sure if the model's actually better. Okay, and we're basically back to the performance I was getting earlier with this guy. So let me put that in. And let's put the results in. Alright, so thanks for watching. That's it for tonight. It's getting kind of late. I gotta walk my dog and go to bed, get ready for work tomorrow. Next stream, I'm going to keep looking through all of the things that basically improved this strategy here and see, if I add them, can I get something that improves this? And then I'm going to try to see, can I get a really good portfolio going? But that's it for tonight. Thanks for watching. Don't forget to like the stream, subscribe, go to the GitHub, check it out. Helps me out if you start the GitHub, watch the GitHub, and follow me on GitHub. And of course, join the Discord. We talk about interesting stuff there. So, thanks for watching. Have a good rest of your night. Adios. And then I'm going to try to see, can I get a really good portfolio going. But that's it for tonight. Thanks for watching. Don't forget to like the